Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at HIVE Digital Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices, and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Okay, so today we are unpacking an incredibly high-stakes corporate pivot.
Oh, absolutely. High stakes is putting it mild.
Right. I mean, we're looking at a company transitioning from being this highly cyclical Bitcoin miner into a high-margin, artificial intelligence infrastructure and high-performance computing powerhouse.
It's a massive shift. Everyone right now is just so obsessed with the AI models themselves, like the software applications or the really fancy silicon chips.
Yeah, the flashy stuff.
Exactly. But if you peel back the layers, the ultimate bottleneck in this whole modern tech race isn't just having a smart algorithm. It's the raw physical power required to just turn those machines on. And HIVE Digital Technologies is, well, they're trying to own that underlying physical reality. All right, let's move into the wealth building context.
Because, look, if we are looking at this from a strict wealth-building perspective, I really have to push back immediately here.
Go for it.
Right now, if you're an investor, you see literally any company that wants a quick bump in their stock price just slapping AI onto their press releases.
Oh, yeah. We've seen beverage companies do it, mattress brands.
Mattress brands. Exactly. So isn't there a massive risk that HIVE is just, another legacy crypto company chasing the AI hype train just because Bitcoin mining got too volatile?
Well, look, skepticism is your best defense mechanism in this market, so that is a vital question to ask. But to understand the context here, you have to look at the physical constraints of the AI boom.
Right.
Compute power has essentially become like the new global sovereignty.
Right.
Because a traditional silicon chip, it processes information sequentially, right? One complex problem at a time. But AI relies on GPU's graphics processing units.
And they work totally differently.
Totally differently. Think of a GPU as a massive stadium full of workers solving millions of simple math problems simultaneously. That parallel processing requires just an astronomical amount of electricity.
Which standard software companies don't know how to handle.
Exactly. Enterprise software companies cannot just pivot into this space because they have absolutely no idea how to manage hundreds of megawatts of electricity or, the massive industrial cooling systems required to keep those GPUs from literally melting down.
And that is actually where the crypto background becomes an advantage, doesn't it?
It is their entire operational DNA. Crypto miners, for all the volatility in their underlying asset, are fundamentally experts at one very specific thing, turning massive amounts of cheap electricity into computing power.
Wow, yeah.
Securing 320 megawatts on a clean energy grid right now is like holding the only water rights in a massive expanding desert. Every AI company out there can buy all the GPU chips they want, but those chips are just seeds. Without the water meeting the massive electricity and cooling infrastructure, nothing grows.
That makes physical infrastructure the ultimate foundational play for long-duration wealth building. Now let's look at the fundamentals.
Right, because connecting that grand vision to their actual accounting ledger reveals a fascinating story of, well, current pain versus future gain.
And the pain is glaring if you just look at the surface numbers. I mean, the latest financials show Q1 revenue sitting at about $93.1 million.
Which is a solid top-line number.
It is. But then you look at the bottom line, and there's a heavy net loss of $91.3 million. And their EBIT margin, which, stands for earnings before interest and taxes, basically measuring core operational profitability, is sitting at a negative 25.5%.
Yeah, that's a tough pill to swallow.
If you're managing your portfolio and you see a company losing a quarter for every dollar it makes, your instinct is to run. I mean, how do you justify a business bleeding that much capital?
Well, it looks alarming if you view it as a finished, steady-state business. But what we're witnessing here is a massive capital expenditure phase. Think of it like building a multi-billion-dollar toll road.
Okay, I like that analogy.
Right. So during the years of pouring concrete, surveying land, blasting through mountains. Your cash flow is deeply negative. You're spending billions and you're making nothing. But once the road is paved and those toll booths open, the marginal cost of the next car driving through is practically zero.
So the heavy net losses right now are just the construction phase.
Exactly. They are actively transitioning their annualized run rate, or ARR, which is the predictable recurring revenue they expect over a year, from $20 million today to an interim target of $35 million by the end of Q4 2026.
But the real inflection point, like the moment those toll booths officially open for massive traffic, is further out. They're targeting 225 million plus in contracted ARR by March 2027.
And here's the metric that should really catch your attention. They're projecting 75% EBITDA margins on those new long-term enterprise GPU contracts.
Wow, 75%.
Yeah, and EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's just a pure look at cash-generating power. Taking the 75% margin means once that high-performance computing segment scales, the operational leverage will theoretically compress those current losses dramatically and just turn into a cash geyser.
Which brings us to the most critical part of building a toll road. You cannot run out of money before you pave the final mile. If you're going to bleed cash for 2 years, your balance sheet is literally your only lifeline. And surprisingly, for a company in a heavy build-out mode, HIVE's balance sheet is remarkably clean. We are looking at a debt-to-equity ratio of just 0.03.
Which means they have almost zero leverage tying them down.
Right. They boast a current ratio of 1.7, meaning they have more than enough short-term liquidity to cover immediate obligations. And their total assets sit at $624 million, with $473 million of that being hard property, plant, and equipment.
They also recently secured $100 million in convertible senior notes due in 2031. And get this, they secured it at a 0% interest rate.
A 0% interest rate in this macroeconomic environment is almost unheard of. I mean, usually if an institution loans you $100 million, they demand a really hefty yield.
Oh, for sure. But the convertible part of those notes means investors have the option to turn that debt into company stock later. The fact that institutions accepted 0% implies they see so much upside in the stock price that they're willing to forego standard interest payments just for the chance to convert it to equity down the line.
That's a massive institutional vote of confidence.
It really is. It gives HIVE this wide runway to fund their infrastructure rollout without relying on highly dilutive stock offerings right out of the gate. And institutions are offering those terms because of HIVE's competitive moat. I mean, they have over 850 megawatts of power globally, 450 operational right now, and another 400 in the pipeline.
And to put 850 megawatts into perspective for you, that's roughly enough electricity to power over 500,000 homes. You don't just call up your local utility company and ask to plug that in.
You absolutely do not. And the crown jewel of this pipeline is a 25-acre site in the Greater Toronto Area, or GTA. They've secured a 320 megawatt power allocation there.
In Toronto, that's huge.
Yeah, and this site taps into Ontario's clean energy grid and utilizes closed-loop cooling systems.
Closed-loop cooling.
Yeah, think of it like the radiator in your car. It recirculates the same water over and over to absorb heat from the servers, rather than pulling millions of gallons from a local river and dumping hot water back into the ecosystem.
Ah, which makes governments very happy.
Exactly. Local governments favor this because it minimizes environmental impact, which means zoning permits are secured way faster. A competitor might have billions of dollars, but securing that specific utility capacity and environmental permitting in a major North American tech corridor, that can take years. That power access is a nearly irreproducible moat.
That brings us to the catalyst timeline.
Because having a vision is great, but as an investor, you want to know the specific events that will trigger the stock's realization of these future targets over the next 3 months. You really need to know how to track the execution.
Right. And the foundational building blocks of this entire timeline are the incremental GPU deployments. The primary event to watch is the Q1 FY 2027 earnings report, which lands in mid-2026.
That's the big one.
That report needs to explicitly quantify the ramp-up of their targeted 11,000 GPUs. That's where you will actually see if the recurring revenue is tracking toward that $35 million interim goal.
You also have physical events on the horizon. There's talk of potential investor site tours for their New Brunswick data center, which is currently undergoing a major fiber network upgrade, and also tours of the new Toronto Gigafactory land.
Oh, getting boots on the ground.
Exactly. Getting institutional investors physically onto the property to see the scale and the power infrastructure is a classic catalyst for price discovery. Seeing is believing for Wall Street.
But the most significant potential catalyst is highly speculative right now, isn't it? The projected cost to build out that massive Toronto Gigafactory is 3.5 billion Canadian dollars. Because that number is so incredibly large, intense market rumors are swirling that HIVE is actively seeking a strategic equity partnership or a joint venture to finance the construction.
And they aren't looking for just any partner. We are talking about a major hyperscaler companies like Microsoft, Google, or Amazon, or even a sovereign wealth fund. Hyperscalers desperately need guaranteed power capacity for their AI models. If an announcement drops that a hyperscaler is partnering with HIVE to fund this build-out, it completely de-risks the capital expenditure phase in a single trading day.
Now let's pivot to the chart.
Because the market is already physically reacting to the fundamentals and the catalysts we just lay out. When the news of the Toronto AI Gigafactory broke, the stock had an explosive reaction. On May 18th, it gapped up on massive trading volume, surging 35% to an intraday year-to-date high of roughly $3.82.
Wow. But if you look at the broader context before that breakout, the stock had actually been in a very steady, grinding uptrend. It climbed from about $2.07 in mid-April up to 2.62, consistently finding strong support and accumulation around that 2.20 to 2.3 range. We even saw a bullish MACD crossover right before the breakout.
Right, and for anyone wondering, MACD stands for Moving Average Convergence Divergence.
Essentially, it compares short-term price momentum against long-term momentum. When you get a bullish crossover, it signals to technical traders that a massive wave of buying pressure is building under the surface. Momentum was shifting positively before the Gigafactory news even hit the wire.
It's a textbook technical setup. But what's truly fascinating here is that even with a 35% single-day surge, the chart shows the stock is still sitting at a near 50% discount from its 52-week high.
Now, if you're managing your risk, this is where alarm bells might start ringing. Buying into a massive gap up is inherently dangerous. You inevitably have short-term traders taking profits, and the initial hype often cools off. If you're building a resilient portfolio, chasing a 35% vertical spike is usually a fantastic way to get burned, because gap ups often fill back down to their previous support levels.
That is a very valid caution.
Yeah.
However, the counter-argument lies in the volume profile. This wasn't some low-volume retail spike driven by social media. The accumulation volume was massive, indicating serious institutional money stepping in and holding the line. Furthermore, because the stock is still down 50% from its 52-week high, there is massive headroom for what we call multiple expansion.
Right, how the market values the company.
Exactly. Right now, the market values HIVE like a cyclical volatile crypto miner, which means it gets a very low valuation multiple. But as they prove this high-margin AI revenue, the market will reprice them as an enterprise tech infrastructure company, which commands a premium valuation multiple. The stock price can shoot up simply from the market changing the label on the company.
So what does market sentiment look like?
Well, we're switching from reading the technical chart to reading the humans and institutions making these massive trades. The overarching narrative shift is aggressive. The consensus among analysts is a strong buy, with mean price targets hovering between 5.50 and 6.68. That represents an upside of over 60% even from the post-spike levels. You have B. Riley holding a $6 target and Rosenblatt at 4.50.
Let's zero in on Cantor Fitzgerald, though. They maintain an overweight rating, meaning they expect the stock to outperform the broader market, but they actually cut their specific price target from $5 to $3. And $3 is notably below the recent 3.82 spike we just saw. How do you reconcile a major analyst cutting a target to a level the stock has already blown past?
It perfectly highlights the tension between near-term valuation metrics and long-term supply and demand realities. Analysts often have to rigidly tie their 12-month price targets to current cash flows, which, as we discussed with the toll road analogy, are currently negative.
Right. The construction phase.
Exactly. But if you contextualize that conservative $3 target against the broader $6 consensus, it shows the variance in how Wall Street struggles to model a corporate pivot this dramatic. Traditional models just aren't built for this. More importantly, you have to look beyond traditional analysts and watch the smart money validation.
You're talking about the internal incentive structures and the elite hedge funds.
Precisely. Internally, HIV's management was recently granted 2.84 million restricted share units with a mandatory one-year vest. That forces management to eat their own cooking. They do not get rewarded unless the stock actually performs over this critical transition period. externally, we saw incredible institutional validation from Leopold Aschenbrenner.
Right. And for context, Leopold Aschenbrenner is a former researcher at OpenAI who launched his own multi-billion-dollar hedge fund called Situational Awareness. He represents the absolute elite inner circle of AI development. He understands where the technology is going better than almost anyone on Wall Street.
And he explicitly named HIVE as a key holding in his fund. When an elite AI insider looks at the entire landscape of the technology sector and decides to allocate capital into a former Bitcoin miner in Canada, it sends a powerful signal to the market. It fundamentally validates the thesis that physical power infrastructure, not just software, is the ultimate bottleneck of the next decade.
Now let's talk about the risks.
Because no corporate transition is guaranteed, and the bear case here is impossible to ignore. Let's address the massive elephant in the room, the cost of scaling. The Toronto Gigafactory is projected to cost 3.5 billion Canadian dollars to build out completely. HIVE's current market cap is only around 720 million.
I have to aggressively press the math on this. How does a $720 million company swallow a $3.5 billion construction project without completely crushing its existing shareholders with stock dilution? I mean, if they issue billions in new stock to pay for this, the value of the current shares will just plummet.
That is undeniably the single greatest risk to the stock. If they rely on equity issuance to fund that build, the dilution would be catastrophic. But this is exactly why we spent so much time examining their balance sheet earlier. Because their debt-to-equity ratio is near zero, they have massive untapped capacity to take on traditional project finance debt without touching their equity. But realistically, standard debt alone will not cover a $3.5 billion gap.
Which brings us right back to the rumor of the hyperscaler joint venture.
It does. The strategic necessity of a joint venture isn't just a nice bonus. It is practically a requirement for a build-out of this magnitude. If they secure a partner like Amazon or Google to foot the massive capital bill in exchange for guaranteed computing capacity, the dilution risk effectively vanishes overnight.
But even if the money magically appears in their bank account tomorrow, you still have massive execution risk. They're targeting 100,000 plus GPUs and hundreds of megawatts of active operational scale by 2027. That is an incredibly aggressive timeline. Anyone who has ever tried to build a simple commercial warehouse knows that global supply chains, local zoning boards, and environmental permitting can delay a project by years.
It is an aggressive timeline, and construction delays are highly probable. However, the mitigation here is that in the world of high-voltage infrastructure, the hardest, most time-consuming part isn't erecting the steel or ordering the servers. The absolute hardest part is acquiring the properly zoned land and securing that 320-megawatt utility allocation from the local government grid. HIVE has already accomplished the hardest part. The remaining phases, while incredibly capital-intensive and prone to standard delays, are essentially known processes in commercial construction.
So with everything on the table, what's the final verdict?
If we synthesize all the fundamental data, the technical momentum, and the massive macroeconomic catalysts, the bullish score comes out to a solid 8 out of 10. The core investment thesis boils down to balancing a high execution and funding risk against the deeply asymmetric upside of owning sovereign AI infrastructure.
And this is absolutely not a stock you buy hoping for a quick flip by next Friday.
Not at all. This requires a multi-year hold, looking at least 12 to 24 months. As an investor, you had to be patient enough to endure the current negative margins and wait for that annualized run rate to scale past the 225 million mark. The true payoff horizon aligns with the operational milestones of the Toronto Gigafactory actually going live and generating cash in the second half of 2027.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is grow $100 to $10 a K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.